You deposit $100 into Coinbase. Click Buy Bitcoin, see your balance update. You now own 0.0015 Bitcoin. But what actually happened to your $100 in that split second? Where did it go? Who has it now? And what journey did it take from your bank account to becoming crypto? Most people have absolutely no idea. They think they bought Bitcoin from Coinbase. Wrong. They think their dollars converted directly to crypto. Wrong. They think the crypto's sitting in their account. Also wrong. And understanding what actually happens changes everything about how you think about exchanges, wallets, security, and why you might lose everything if you do not know these 7 steps. I am going to walk you through the exact journey your money takes when you buy any cryptocurrency. Bitcoin, Ethereum, Cardano, Solana, whatever. The process is the same. And by the end, you will understand why not your keys means not your coins, why exchanges can freeze your funds, and why that crypto in your account might not actually exist. Let me start at the beginning. Step 1. Your bank account to the exchange. When you transfer $100 from your bank to Coinbase or Binance, that money does not arrive instantly. It goes through the traditional banking system. ACH transfer if you are in the United States, SEPA if you are in Europe, wire transfer if you are international. This process takes 1 to 5 business days, not seconds, days. During that time, your money is in transit. It leaves your bank, passes through intermediate clearinghouses, maybe correspondent banks, eventually arrives at the exchange's corporate bank account, not a crypto wallet, a regular fiat bank account, at Bank of America or HSBC or wherever the exchange banks. Your dollars sit there in a traditional bank, earning the exchange interest while you wait. Some exchanges offer instant deposit using debit cards or credit cards. That feels faster, but here's what's actually happening. The exchange lends you crypto immediately against your incoming deposit. They take the risk that your bank transfer will clear. If it does not, they claw back the crypto from your account, freeze your funds, demand payment. That is why instant deposits have higher fees, 2 to 4% instead of 0.5% for bank transfers. You are paying for convenience and speed. The exchange is taking on credit risk. Step 2. Dollars convert to stablecoins first. Here's what almost nobody realizes. When your $100 hits the exchange, it does not stay as dollars. Exchanges do not hold billions in actual US dollars. They convert your dollars to stablecoins, usually USDT Tether or USDC. This happens automatically, invisibly. The exchange makes it look like you have dollars, but you actually have stablecoin IOUs. Why? Because stablecoins are easier to move, faster to settle, cheaper to store, and exchanges can use stablecoins across multiple blockchains and trading pairs without maintaining separate dollar reserves for each market. When you deposit $100, the exchange buys 100 USDC. Your account shows $100 balance, but under the hood, stablecoin. This matters because stablecoins have risk. Tether has been accused of not having full dollar backing. USDC temporarily depegged in March 2023 when Silicon Valley Bank collapsed. If a stablecoin loses its peg or the issuer goes bankrupt, your dollar balance on the exchange is affected. Not insured, not protected, gone. This is why keeping large amounts on exchanges is dangerous. You are not holding dollars, you are holding stablecoin exposure. Step 3. The order book match. Now you click Buy Bitcoin. The exchange does not sell you Bitcoin from their own inventory. They are not a Bitcoin dealer. They are a matchmaker. Your buy order goes into an order book, a digital ledger showing all buy orders and all sell orders for Bitcoin at different prices. Your order gets matched with a seller, someone who wants to sell Bitcoin at the current market price, maybe another retail trader, more likely a market maker, a professional firm that places both buy and sell orders to profit from the spread. The exchange matches your USDC with their Bitcoin. The trade executes, your account shows Bitcoin, their account shows USDC. The exchange takes a fee, usually 0.1 to 0.5%. But here's the critical part. This trade happens inside the exchange's internal database, not on the blockchain. No Bitcoin actually moved. The exchange just updated 2 database entries. Your row says you own Bitcoin, the seller's row says they do not. That's it. No blockchain transaction occurred. This is why trades are instant, database updates are fast, blockchain confirmations take minutes. Step 4. where your money actually went. So, where is your $100 now? It went to the seller, the person or market maker who sold you Bitcoin. They now have USDC in their exchange account. If they withdraw, they convert USDC back to dollars and send it to their bank. If they trade, they use that USDC to buy other crypto. But your original dollars, they are no longer yours. They belong to whoever sold you Bitcoin. And the exchange, they took a fee. 0.25% maybe, 25 cents on your $100 trade, times millions of trades per day, times thousands of dollars per trade. Exchanges make billions in fees. Coinbase revenue in 2025, over $7 billion, from matching buyers and sellers, taking tiny cuts at scale. Step 6. Your Bitcoin is an IOU, not real Bitcoin. This is the part that shocks people. When you see Bitcoin in your Coinbase account, you do not actually own Bitcoin. You own an IOU, a promise from Coinbase that they owe you that amount of Bitcoin. The actual Bitcoin sits in Coinbase's wallet, not yours. You do not control the private keys. You cannot move it without Coinbase's permission. If Coinbase gets hacked, your Bitcoin is at risk. If Coinbase goes bankrupt, you are an unsecured creditor, not an owner. This is what not your keys, not your coins means. When crypto is on an exchange, the exchange controls it. You have a database entry. That's all. FTX proved this. Users had balances showing billions, but FTX did not actually have that crypto. They loaned it out, lost it, gambled it. When users tried to withdraw, the money was gone. Database entries meant nothing. Step 7. Blockchain transfer only happens when withdrawal. Only when you withdraw does blockchain activity happen. You request withdrawal to your personal wallet. The exchange verifies your request. They create an actual blockchain transaction, sending Bitcoin from their wallet to your wallet address. That transaction gets broadcast to the Bitcoin network, miners confirm it, add it to a block, and now you truly own Bitcoin. It's in your wallet, your keys, your control. But withdrawals cost fees, network fees paid to miners plus exchange withdrawal fees. Coinbase charges 0.0005 Bitcoin per withdrawal, about $3 at current prices. Binance charges 0.00018 Bitcoin, about $1.20. Those fees add up. That's why many people leave crypto on exchanges to avoid withdrawal costs, but they are trading convenience for security, and that trade can cost them everything. Step 7. Self-custody means true ownership. When you withdraw to a hardware wallet like Ledger or Trezor, you control the private keys. The blockchain shows your address owns Bitcoin, not Coinbase, not Binance, you. If the exchange collapses tomorrow, your Bitcoin is safe. If governments seize exchange assets, your Bitcoin is untouched because it's not on the exchange, it's on the blockchain, in your wallet, under your control. But self-custody has responsibility. If you lose your private key or seed phrase, your Bitcoin is gone forever. No customer service, no password reset, no recovery. That's the trade-off. Total control, total responsibility. Exchanges offer convenience and support, but no ownership. Hardware wallets offer ownership, but no safety net. What this means for you. Understanding this 7-step journey changes how you use crypto. First, don't keep large amounts on exchanges, only what you are actively trading. Everything else, withdraw to self-custody. Second, understand you are trusting the exchange with your money. They can freeze accounts, halt withdrawals, go bankrupt. You have no protection. Third, stablecoins are not dollars. They have issuer risk, regulatory risk, depeg risk. Do not treat them as safe. Fourth, trades on exchanges don't happen on blockchains. They happen in databases. That creates counterparty risk. The exchange must be solvent and honest for your balance to mean anything. Fifth, withdrawal fees are the price of ownership. Pay them. Move crypto to wallets you control. Don't leave it with custodians just to save a few dollars. And sixth, learn the difference between custodial and non-custodial. Custodial means someone else holds your keys. Coinbase, Binance, Robinhood. Non-custodial means you hold your keys. Ledger, Trezor, MetaMask. Only non-custodial is true ownership. Everything else is just a promise. The risks nobody explains.
Exchanges can get hacked. Mt. Gox lost 850,000 Bitcoin. Exchanges can freeze accounts for KYC issues, for suspicious activity, for no reason. Exchanges can halt withdrawals during volatility. When everyone wants to sell, exchanges lock the doors. You can't get your money out. And exchanges can go bankrupt. FTX, Celsius, BlockFi, Voyager, billions lost. Your $100 bought you exposure to Bitcoin price, but it did not buy you Bitcoin ownership, not until you withdraw. And most people never withdraw. They leave crypto on exchanges, trusting custodians, not understanding that their crypto is just database entries that can vanish if the exchange fails. If this breakdown finally made you understand what actually happens when you buy crypto, smash that like button. This is critical knowledge that most people never learn until it's too late. Subscribe for more content that explains the mechanics behind crypto instead of just hype and price predictions. Drop a comment. Did you know your crypto on an exchange is just an IOU? Did you understand the stablecoin conversion? Did you know trades don't happen on blockchains? I want to know what shocked people most. And share this with someone who just started buying crypto, because
Understanding this before they lose money could save them thousands, maybe millions. Not your keys, not your coins. Now you know why. I will see you in the next one. Stay sovereign out there.